the ultimate guide to REIT investing. Maximize your wealth with real estate investment trusts. Welcome to our channel. Today, we're diving into the world of real estate investment trusts, or REITs. If you're looking to invest in real estate without actually buying property, this video is for you. We're breaking down everything you need to know about REITs, from the basics to advanced strategies that can help you maximize your wealth. So stick around, because this is going to be an informative ride. Let's start with the basics. What exactly is a REIT? Well, a REIT is a company that owns, operates, or finances income-producing real estate. Think of it as a way to invest in real estate without the hassle of actually owning and managing properties. Instead of buying a rental property and dealing with tenants, you can simply buy shares of a REIT, and boom, you're a real estate investor. REITs are designed to pool the resources of many investors, giving each of them access to a diversified portfolio of real estate assets. These assets can range from shopping malls and office buildings to apartments, hospitals, and even data centers. The beauty of REITs lies in their accessibility. Whether you're investing a few $100s or a few million, you get a piece of the real estate action. REITs are also required by law to distribute at least 90% of their taxable income to shareholders in the form of dividends. This means that as a REIT investor, you can expect regular income, which is one of the key attractions of REITs compared to other types of investments. There are different types of REITs you can invest in. First, we have equity REITs, which are the most common. These REITs own and operate income-producing real estate like shopping malls, office buildings, and apartments. Essentially, equity REITs make money from leasing space and collecting rents on the properties they own. They also can profit from the appreciation in property values over time. Next up are mortgage REITs, often referred to as MREITs. Unlike equity REITs, mortgage REITs don't own properties directly. Instead, they focus on financing real estate by purchasing or originating mortgages and mortgage-backed securities. Mortgage REITs make money by the interest they earn on these loans. They can be a bit more volatile than equity REITs because their performance is closely tied to interest rate movements. Lastly, there are hybrid REITs, which combine both equity and mortgage investments. These REITs invest in both properties and mortgages, giving them the potential to benefit from both rental income and interest income. While hybrid REITs offer diversification within the REIT sector, they can also be more complex to analyze due to the dual nature of their assets. Each type of REIT comes with its own set of risks and rewards, so it's important to understand how they work and choose the ones that align with your investment goals. So, why should you consider investing in REITs? One of the biggest reasons is their performance. Over the long term, REITs have delivered solid returns, often outpacing other asset classes like stocks and bonds. For example, if you look at the historical data, REITs have consistently provided strong total returns through a combination of capital appreciation and dividend income. REITs also offer the benefit of diversification. Because they invest in real estate, REITs don't always move in tandem with the broader stock market. This means that adding REITs to your portfolio can help reduce overall risk by providing exposure to a different asset class. And it's not just about diversification within your portfolio. REITs themselves are often diversified across multiple properties and geographic locations, further spreading out risk. Moreover, the real estate market has its own cycles, which can sometimes provide a hedge against stock market volatility. During periods of economic growth, demand for commercial and residential real estate tends to rise, boosting the performance of REITs. Conversely, even during downturns, certain types of REITs, such as those focused on essential services like healthcare or logistics, can remain resilient. Another major benefit of REITs is their dividend payouts. By law, REITs are required to distribute at least 90% of their taxable income to shareholders in the form of dividends. This makes them an attractive option for income-focused investors. Whether you're looking for regular income during retirement or just want to generate passive income, REITs can be a great addition to your portfolio. Dividends from REITs are typically higher than those from other types of stocks because of this mandatory payout structure. For income investors, this feature of REITs provides a steady and reliable stream of cash flow. Moreover, because REITs are required to pay out most of their earnings, they tend to be more disciplined with their capital, focusing on efficient management and high-quality investments. But there's more to it. REIT dividends can be particularly appealing in a low-interest rate environment where traditional income investments like bonds offer lower yields. However, it's important to understand that REIT dividends are typically taxed as ordinary income, so you'll need to consider this when planning your tax strategy. Now, let's talk about how to evaluate REITs. When analyzing REITs, traditional metrics like price-to-earnings ratios aren't always useful. Instead, you should focus on metrics like funds from operations FFO, which is a measure of cash generated by the REIT's operations. FFO is calculated by adding depreciation and amortization back to net income, as these are non-cash charges that don't affect the REIT's cash flow. There's also adjusted funds from operations FFO, which takes into account capital expenditures and other factors, giving you a clearer picture of the REIT's financial health. AFFO is considered a more accurate measure of a REIT's ability to generate income because it includes maintenance costs and other recurring expenditures that are necessary to sustain the REIT's assets. And don't forget to check the net asset value (NAV) to understand the value of the underlying real estate assets. NAV represents the market value of a REIT's properties minus its liabilities. Comparing the REIT's share price to its NAV can give you an idea of whether the REIT is trading at a premium or a discount relative to its true value. By using these metrics, you can make more informed decisions about which REITs are worth your investment. To give you a better understanding, let's take a look at a case study. One of the most successful REITs in recent years is Blackstone Group LP NYSE. BX. They've built a diversified portfolio of properties across multiple sectors, and their financial performance has been stellar. By carefully managing their assets and capitalizing on market opportunities, they've been able to deliver consistent returns to their investors. This is a great example of what a well-managed REIT can achieve. For instance, Blackstone Group has strategically invested in high-demand properties like urban office spaces and industrial warehouses, which have seen significant growth due to trends like urbanization and e-commerce. They've also maintained a strong balance sheet, with low debt levels and ample liquidity, allowing them to weather economic downturns and seize opportunities when they arise. Moreover, Blackstone Group has a strong track record of dividend growth, which is a key indicator of its financial health and commitment to returning value to shareholders. Investors who bought into Blackstone Group early have seen not only their share prices appreciate, but also their dividend payouts increase over time, demonstrating the power of compounding in dividend reinvestment. versus convenience. If you're looking for specific REITs to invest in, here are a few top performers across different sectors. In the retail sector, Simon Property Group SPG has been a standout, with a portfolio of high-quality shopping centers that have consistently attracted strong tenant demand. Their focus on prime locations and premium tenants has helped them deliver solid returns and maintain a high occupancy rate. In the residential sector, Essex Property Trust TSS has done exceptionally well, particularly in high-demand urban areas. They've been able to capitalize on trends like urbanization and the growing preference for rental housing, which has driven up both rents and property values in their portfolio. For those interested in healthcare, Welltower NYSE offers exposure to a sector that's expected to see significant growth as the population ages. Their portfolio includes a mix of hospitals, senior housing, and medical office buildings, all of which benefit from stable, long-term demand drivers. And let's not forget about industrial REITs like Prologis NYSE PLD, which have seen a surge in demand due to the rise of e-commerce and the need for modern logistics facilities. These REITs have been able to deliver strong returns by investing in strategically located properties that serve as key hubs for major logistics networks. These examples show that there are opportunities across various sectors, and choosing the right REITs can provide both growth and income potential. How do REITs perform during different economic cycles? This is an important consideration for any investor. During periods of economic growth, REITs tend to perform well, as demand for real estate increases and rental income rises. This is especially true for sectors like office and retail, where business expansion drives demand for space. However, during economic downturns, some REIT sectors may face challenges. For example, retail REITs might struggle if consumer spending declines and stores close, leading to higher vacancy rates and lower rental income. On the other hand, sectors like healthcare and residential REITs often show resilience, as they are supported by essential needs that remain consistent regardless of economic conditions. It's also worth noting that interest rates play a significant role in REIT performance. REITs often borrow money to finance their real estate purchases, so rising interest rates can increase their borrowing costs and reduce profitability. Conversely, when interest rates are low, REITs can benefit from cheaper financing and higher property values. Understanding these dynamics can help you navigate REIT investments across different market environments. If you're new to REIT investing, here's a quick checklist to get you started. First, research different types of REITs. Do you want to invest in retail, residential, healthcare, or maybe a mix of sectors? Each sector has its own set of dynamics and risks, so it's important to choose one that aligns with your investment strategy. Next, evaluate the financial health of the REITs you're considering. Focus on key metrics like FFO, AFFO, and NAV, and pay close attention to the REIT's dividend history. A consistent track record of dividend payments and growth is often a good sign of a strong REIT. Diversify your portfolio by investing in multiple REITs across different sectors. This helps spread risk and increases your chances of benefiting from growth in different parts of the real estate market. You can also consider REIT ETFs or mutual funds if you want to gain broad exposure with a single investment. Finally, stay informed about market trends and economic indicators that could impact your REIT investments. Regularly review your portfolio and make adjustments as needed to ensure it continues to align with your financial goals. By following these steps, you'll be well on your way to building a successful REIT investment strategy. And that's a wrap on our ultimate guide to REIT investing. We hope you found this video helpful and that you're now feeling more confident about diving into the world of REITs. If you have any questions or want to share your own REIT investing experiences, drop a comment below. And don't forget to hit that like button and subscribe to our channel for more insightful content on investing and personal finance. Thanks for watching, and happy investing!